Welcome to the deep dive. We're jumping straight into some pretty significant news from the beauty sector today.
Yes, we're looking at Ulta Beauty, specifically their Q2 Fiscal 2025 results, which were frankly quite strong.
And what that updated outlook tells us about where they're headed.
Exactly. Our goal here is to quickly break down these numbers, understand the strategy behind them, and really give you the key takeaways for Ulta's year ahead and beyond.
Okay, let's get straight to it then. Ulta's second quarter ending August 2nd. What are the headline numbers?
Well, they're impressive. Net sales surged 9.3%, hitting $2.8 billion.
Wow, 9.3%. That sounds like it beat expectations.
It did, yeah, by nearly 5%, actually. And the really key metric, comparable sales, they jumped 6.7%.
6.7% comp sales after a decrease last year.
Exactly. Last year, same quarter, it was down 1.2%. So this is a huge swing and more than double what analysts predicted.
Okay, so serious momentum there. What about the bottom line, earnings per share?
Also very strong. Diluted EPS hit $5.78. That's up 9.1% year over year.
And compared to forecasts?
Beat those two. Came in almost 16% above the $4.99 that was expected. So yeah, strong performance top to bottom.
What's driving that comp sales number? Is it more people shopping or people spending more?
It's actually a mix of both, which is healthy. Transactions were up 3.7%.
Okay.
And the average ticket, how much each person spent, that rose 2.9%. Shows broad strength.
And the market reacted well, I assume.
It did. The stock ticked up about 1.14% in after-hours trading, pushing it near its 52-week high. So definitely a positive reception.
All right, so Q2 looks great. But one strong quarter is one thing. What about the rest of the year? Did they update their full-year guidance?
They did, and this is a key takeaway. They significantly raised their guidance for fiscal 2025.
Raised it by how much?
Quite a bit. For net sales, the new projection is $12.0 billion to $12.1 billion.
Okay, and the old range was?
$11.5 billion to $11.7 billion.
Yeah.
So, yeah, pretty substantial increase.
That's a big jump. What about comparable sales for the full year?
Also revised upwards, they now expect growth between 2.5% and 3.5%. Previously, the outlook was flat to up 1.5%. So, again, a much more positive forecast.
And EPS guidance follows suit.
Yes, diluted EPS is now expected between $23.85 and $24.30. That's up from the prior range of $22.65 to $23.20.
Interesting. So strong Q2 performance leading to a much higher outlook for the year.
Pretty much, although the CEO, Kecia Steelman, did add a note of caution.
Oh, what did she say?
Well, she mentioned the outlook reflects both the strength they've seen so far, but also some caution about how consumer demand might shape up in the second half.
So tempering expectations slightly for the back half.
Sort of. They're forecasting comparable sales for the second half to be somewhere between flat and up low single digits. Suggests they see maybe some moderation after the really strong first half.
Okay, that makes sense. A bit of prudence baked in despite the current strength?
Right. Balancing the knowns with potential economic uncertainties ahead.
Let's dig into the why behind these Q2 wins. It's great to see the numbers, but how did they pull it off? What were the key drivers?
Well, it wasn't just one thing. It really looks like a combination of executing their strategy well and tapping into that resilient beauty market.
Okay.
The CEO highlighted growth across all major categories. It wasn't just one area carrying the load.
All categories, even makeup?
Even makeup, yeah. Both mass and prestige saw mid-single-digit growth. But fragrance was apparently a huge standout.
Fragrance, really?
Yeah, robust double-digit growth there. They mentioned new brands like Drake Summer Mist, YSL, Gucci, Chanel, plus exclusives helping drive that.
Interesting. And skincare, wellness?
Both saw high single-digit growth. Newness was key there too, with brands like Tatcha, Soltaire, and strong K-beauty assortments performing well.
So the product mix and newness is clearly working. What about their broader strategy, this Ulta Beauty Unleashed plan?
That definitely seems to be gaining traction. A big part of it is constantly introducing new and often exclusive brands. They launched 24 new ones just in Q2.
24, wow.
Yeah, names like Isama, Inky List, Goop Beauty. And they've got more coming, like Moroccan Oil, Pattern Body, even Rihanna's Fenty Skin Body. That keeps things fresh.
Absolutely. What else falls under that Unleashed umbrella?
A lot of focus on elevated marketing and engagement, going beyond typical ads.
Like what?
Well, they had activations at Coachella, Lollapalooza. They were even the official beauty retail partner for Beyoncé's Cowboy Carter tour.
Partnering with Beyoncé, that's big.
Right. It's about building, as they put it, cultural relevance.
Yeah.
Especially connecting with younger consumers.
Makes sense. And operationally, any improvements there?
Yes, they highlighted better in-store execution, better digital personalization, and importantly, a real focus on reducing inventory shrink
Ah, shrink. Theft and damage control, that impacts margins, right?
significantly.
Hmm.
And improvements there helped boost their gross profit margin by 90 basis points, up to
Yeah.
39.2% of net sales.
Okay, so product marketing, operations, and loyalty must be huge for them too.
Foundational.
Hmm.
Their loyalty program grew 4% year over year. They now have a record 45.8 million members.
45.8 million. That's massive engagement.
It really is. And it ties into their omnichannel success, too. They mentioned half their e-commerce orders are actually fulfilled from stores.
So buy online, pick up in store, or ship from store is working really well.
Exactly. It leverages their physical footprint effectively.
It really sounds like a well-oiled machine right now. Tapping into that idea the CEO mentioned, that beauty offers comfort and escape.
I think that's a key insight, especially when times might feel uncertain elsewhere. That affordable luxury, that moment of self-care, it remains important. Ulta seems perfectly positioned for that.
Okay, beyond the quarter's results, Ulta also made some really big strategic moves. Let's talk about those. International expansion seems to be a theme.
Definitely. They're not just relying on the U.S. market. The big news was acquiring Space NK in July.
Right, the British retailer. How does that fit in?
While Space NK has 83 stores in the UK and Ireland, it gives Ulta an immediate established foothold in a major European beauty market without having to build everything from scratch.
So buying expertise and presence, will they rebrand them?
No, Space NK will operate as a standalone subsidiary. Ulta can learn the market while keeping the established brand identity. It's a less capital-intensive way to go international.
Smart. And are there other international plans?
Yes, they just had a soft opening for their first store in Mexico,
Mexico too. Okay.
and they plan to open their first store in the Middle East later this year. So it's a multi-front international push.
Wow, okay. UK, Mexico, Middle East. That's ambitious. What about closer to home, the wellness focus?
Yes, they're expanding their wellness shop concept significantly. It's already in 370 stores,
Uh-huh.
and they're adding 50 more with even bigger assortments in Q3. The CEO thinks wellness could be a billion-dollar business over time for them.
$1 billion just from wellness. That's tapping into a huge trend.
Absolutely. It's a $410 billion market they're aiming for a piece of. And then there's the new online marketplace.
Right. Tell us about that. How's it different from their regular site?
It's launching in Q3, and it's described as invitation only. It lets them add way more products, beauty, wellness, lifestyle, without needing physical shelf space.
Invitation only means they curate the brands.
Exactly. They control the assortment, keep it aligned with their brand, and importantly, loyalty members can earn points on marketplace purchases.
Ah, integrating it into the loyalty program. That's clever.
Keeps people within the Ulta ecosystem.
Okay, so lots of expansion, but then there's the news about the Target partnership ending. How does that fit? Seems like a step back in reach.
Well, they announced mutually that the shop-in-shop partnership ends in August 2026.
Right. Was it not working out?
It wasn't a huge part of their sales, actually. The royalty revenue was less than 1% of their net sales last fiscal year.
Less than 1%. Okay. Maybe not as impactful as it seemed from the outside.
Right, and Ulta actually framed it as an upside potential opportunity.
Upside. How so?
Their thinking is they can recapture those Target shoppers directly into their own Ulta stores or website. And when they do that, the profit margin, the flow-through, is much higher.
Ah, so they keep the wholesale, basically. No sharing revenue with Target.
Exactly. Plus, they get full control over the customer experience and the data. It lets them focus resources on their core strategy, their own stores, website, the new marketplace, international efforts.
So it's like, thanks for the ride, Target, but we're ready to drive these customers ourselves now.
Something like that, a strategic realignment to focus on their own channels where they see more long-term value.
Okay, that makes strategic sense. Now, with all this spending, the Space NK acquisition, new stores, launching marketplaces, how's their financial health holding up? Let's look at the balance sheet.
Well, they did draw on their credit facility for the Space NK deal, as you'd expect, but overall, they seem to be in a healthy position.
What about inventory? It went up quite a bit, right?
It did, yeah. Merchandise inventories rose 20.5% to $2.4 billion.
Is that a worry? Piling up stock.
Not necessarily. They attributed it mostly to stocking up for new brand launches, prepping the 62 net new Ulta stores planned for the year, and of course, integrating the 83 Space NK stores inventory. So it seems like a strategic build for growth.
Okay, inventory to support sales, not because sales are slowing. Got it. Are they still buying back shares with all this investment going on?
They are, yes. They bought back about $109.5 million worth of shares in Q2.
Still committed to shareholder returns then?
Definitely. They still have $2.2 billion left on their current authorization. So plenty of room there. And they're still opening stores, 24 new ones in Q2, bringing the U.S. total to 1,473.
Okay. What about profitability margins going forward with these investments? Did they update the operating margin outlook?
They did. For the full year, they're now guiding to 11.9% to 12.0% operating margin.
Which sounds pretty good.
It is. But similar to the sales guidance, there's a bit of caution for the second half. They expect margins to moderate slightly, maybe 10.7% to 10.9% in the back half.
Why the expected pressure?
A few things. Shifts in timing for investment spending, higher incentive pay for employees because, well, performance has been better than planned.
Right. Good problem to have.
And also, the benefits they got last year from reducing inventory shrink are starting to level off, so the year-over-year comparison gets tougher. It really points to a conscious investment phase.
Spending money to make money, basically.
Yeah.
Investing now for future growth from these new initiatives.
That seems to be the story. They're willing to accept slightly lower margins in the short term to fuel that unleashed strategy, the international push, wellness, and the marketplace, betting on long-term returns.
Okay, so wrapping this up, what are the key takeaways for you, our listener?
I think the big picture for Ulta's Q2 is one of really significant outperformance. You have a beauty consumer who remains resilient, combined with Ulta doing a lot right, managing categories smartly, bringing in newness, and making some bold strategic bets.
Bets on international markets, on wellness, on that digital marketplace.
Exactly. And while their guidance for the rest of the year has that note of caution, reflecting the wider economy, the core strategy seems to be working, creating these new pathways for growth and building a more diversified business overall.
It really does feel like a company actively shaping its own destiny in a pretty fast-moving market.
Which leaves us with something to think about. As Ulta exits the Target partnership and dives deeper into these international waters in its digital marketplace, how is that going to shake up the beauty retail landscape over the next few years? What forms will that consumer need for comfort and escape take next? And how will Ulta adapt to keep capturing it?